Good morning, everybody, or afternoon for those of you on the incorrect coast of the United States. My name is Jason Bowman, and I'm joined today by Mr. Dan Henn. And welcome to this month's presentation of our IRS Collections Representation Level 2 curriculum. This is a follow-on to our Level 1 curriculum, which hopefully most of you have been through or through something similar. Over the course of the next 3 weeks, we will be covering several important topics that build on the Level 1 material, starting today with offers in compromise. So before we get started, do bear in mind that we do have polling questions. Yes, they are the same cheesy, ridiculous, crazy, zany polling questions that you have come to know and love from us. And I'm lumping Dan into that, much to his chagrin. The way this works is that if you are a CPA and you're in a jurisdiction where you can receive half credit, then if you answer 5 polling questions, you'll get 1.5 hours of credit. If you answer 6, you'll get the 2 full hours. If you are an enrolled agent and you answer 5 questions, we cannot grant half credit to under IRS rules. Therefore, it will be dropped down, rounded down to 1 hour. So EAs, you must answer either 3 or 6 polling questions. Anything in between gets rounded down to 3, okay? This is a world of acronyms, so please do not hesitate to ask what they mean. Dan is primarily driving the boat today, and he is generally a lot better about explaining those as he goes than I am, so that probably shouldn't be an issue today. You can grab the slides from the handouts pane in the GoToWebinar control panel, and also sent out an email through Eventbrite with the slides. The original GoToWebinar email, I had the link in there from last month, so that was the wrong stuff. Use the GoToWebinar control panel to ask any questions throughout the presentation. And I need to update this slide. The IRS CE portal is actually back online with no issues. So we'll get CE and CPE reporting will be taken care of in aggregate for the month. So for this 3-session series, you will receive 1 certificate of completion at the end of March. Okay, so just to make that clear, and that's different from what's on your screen. So without further ado, Mr. Henn, take it away.
Okay, everyone out there, this is Dan Henn talking to you from the correct coast on the East Coast. I am in Rockledge, Florida, just east of Orlando, in the area known as the Space Coast. For those of you that are not familiar with Jason and I, he's in Seattle and I'm over here in Florida, and many of you are around the country. So if you're tuning in, especially if you're on the northeast coast, you're probably snowed in or sitting here hopefully enjoying this stuff by the fire. But anyway, just hopefully everybody can hear us. Let us know. Just chime in where you're from and what's the weather like there, and we'll see that. Put that in the questions. So we're just making sure everybody's out there. And again, as Jason said, if you have any questions as you go along, we will periodically answer those questions, generally during polling questions. And again, I apologize for the polling questions. I have nothing to do with them. Jason's sense of humor. So we've got a few people here. Frankie's in Norfolk with 19 degrees, snow in Philadelphia, beautiful in Houston. Well, it's beautiful here, a little cloudy, but we're supposed to hit 84 degrees today here in Florida. So without further ado, as Jason mentioned, we're going to go through talking about offer and compromise. It is just as anything is usually in the tax world, it is very laden with acronyms. I do try to do a pretty good job to explain those things. But again, if there is, don't hesitate to ask. The only question not asked only stupid question is the question not asked. So here we go with course objectives. So at the end of today, we're going to help you understand what's the pros and cons of offer and compromise, understand the requirements and conditions of the offer and compromise program, OIC, for those of you guys who don't know. We're going to define the different types of offers, explain the payment options. We're going to understand the role of RCP, which is also known as reasonable collection potential, and what we're going to say what that is and show you what it means in the whole process. We're going to go a brief look into the IRS collection financial standards and how we use that to collect the information to prepare the offer and compromise. We're going to again understand the offer application process and what makes it processable versus not processable. Excuse me. We're also going to understand the investigation process from the IRS side, so hopefully you can do things to avoid having your offer either rejected or sent back to you, which just delays things. And then finally, we're going to make sure that you understand the responsibilities after the offer acceptance, because unfortunately it's not just as simple as submitting the offer. There's some steps that they must do, and with the emphasis on must do, otherwise all is null and void in regards to offer and compromise. So next slide, Jason. So with that, is that our first polling question? So if you guys would answer the first polling question, any questions at this? Oh, look at our friend John Walters says he says I'm still on the wrong coast because he's on the west coast of Florida. I'm on the east coast of Florida. So I still think it's nicer over here. I used to live on the west coast of Florida, but to me, being over here is much better. To me, if you have a beach, you got to have waves. To me, the Gulf of Mexico it's nice to have a body of water, but if it doesn't have 4-inch waves, doesn't cut it for me, John. So answer the polling question here. We'll give you a few seconds more to answer this. And again, as Jason pointed out, you must answer all 6 questions for CPAs, EAs, if you want to get the full 2 credits that we have here for you today. So anywhere, let's see, where else we got? We got Thomas in DC who says he's going from the 70s to the 20s today. I don't know how you guys do that. We rarely do we get more than 20 or 30 degree swings, and you guys are getting 50 degree swings. So 10 more seconds here. Answer your polling questions. We are at 91% of you voting, so please make sure you do it. It's always interesting how these people answer our wonderful polling questions. 35% of you so right now like a blue scarf being waved, because most of you know that a red scarf is going to make you come at it. They're going to make them come at you.
Well, remember,
it's now a tie with 35% and take away its credit cards.
As I say, don't forget these polling questions. Wait, how did the voting percentage go down?
I don't know. I just saw that. That went to 87%. Somebody took away their answer.
Be sure you hit the submit button. Be sure you
hit the submit button if you're not familiar with this.
We got to move along, but there's a few of you that still haven't put an answer in, so...
Now it's back at 91.
Snooze, you'll lose.
3, 2, 1, end polling question. Which then takes us to the next slide. And our poor friend Randall, who is 11 degrees in Minnesota. Randall, I feel sorry for you.
Nice!
But, you know that that's Jason's kind of weather, not mine. So back to the offer and compromise. Benefits. First, you get to settle the tax debts for less than what you owe. And that's the biggest thing. That's what most people know about offers and compromise. When you hear those commercials that, especially when the commercials that I've seen them where they say, I paid $10,000 on a $100,000 bill. The way they present those in these tax offer mill companies, that they are everybody fits in an offer and compromise. And I can tell you that it doesn't. We're not going to go through the statistics of this, but there's roughly 7 million new cases every year. There's 13 million open at any one point in time, and less than, 0.37%, Jason, that
Correct.
is settled through offer?
Correct.
Is that correct?
Yes.
Yeah. So 0.37% get resolved through offer. That means that I think the math comes around to about 28,000 cases get resolved through an offer and compromise. So not everybody fits, and we'll go through more in detail. Now, this is one of the few instances where it actually eliminates penalties and interest. We all know that we can potentially get penalties abated, but generally interest is not. And the only way that you can get rid of interest is to reduce the tax liability, and that's what we do here in the offer and compromise, that they all get compromised, including the penalties and interest. The nice thing about offers and compromise is also there in number 3. There's no enforced collections activities. So once you've submitted your offer, then until they either reject it or accept it, nothing else can happen. So if it takes them a year to do it, if it takes them a year and a half to do it, and then they can't come after you, they're not supposed to do any further levies or garnishments on bank accounts or payroll. Number 4, there's no limit to the amount that can be settled. So if you have somebody who's got millions of dollars, that can also be settled. It's all facts and circumstances depending on what's involved. Obviously, $1 million of liability, chances are you're going to have a big case just from the standpoint of the documentation that must be submitted. So when it comes to fees, you need to make sure that you're quoting accordingly and the time that's going to be involved in that. Now, in this case, also know in number 5 that the government can't later reopen the case unless evidence of fraud is found. So, because at the end of the day, what you're doing is you're entering into a legal binding contract. And so if they find that you fraudulently hid assets and did things that they later find, then you've got problems. So this is one of those, always make sure your clients aren't blabbing to, if they're getting away with murder kind of a thing, that they're blabbing to their friends, because unfortunately even friends can stab people in the back. But if you find that you've got any people that for any reason that they're not giving you straight answers or information, you should have them go find somebody else. Number 6, low-income qualifications may waive application fees. I believe the last I saw was $186 for the application fee. Correct me if I'm wrong on that, Jason. I don't know that that's changed yet. But the application fee as well as the down payments, so if you have a 20%, you're taking the 20% down payment route, that can be waived or reduced. So keep that in mind. Lien removal will happen upon payment of the offer. And then once that has happened, now your client can go about their business. Again, we'll talk about it later about the requirements, the must-dos after the offer has been accepted, that they have to be on the straight and narrow for the next 5 years. And then finally here, the reasonable alternative, it's a reasonable alternative to the installment agreement or currently non-collectible. And if you see it referenced, IA is installment agreement, CNC is currently non-collectible. Those are the abbreviations we use for that. So just keep in mind that there are instances, like for example, the partial pay installment agreement is the one that usually is more akin to an offer and compromise, and then it just depends on whether or not your client can come up with the cash to deal with the offer and the program that you want. Now keep in mind there at the end there, the goal is to achieve collection of what is potentially collectible at the earliest possible time and at the least cost to the government. So ultimately that's what they're trying to do. They want to collect as much as they can, but at the end of the day, they just want people to be able to go about their lives and become good little taxpayers going forward. So that's your job then, to try and keep people on the straight and narrow, again, assuming they're paying you for handling that. Sometimes it can be sort of a babysitting job if you want to look at it, because unfortunately I'm sure many of you have dealt with many clients that are like that. So next slide, Jason. Did you want to add anything else in regards to the benefits?
Nope, we're good.
Okay. So let's talk about the downside. Downside. Well, the biggest problem with the offer and compromise is that you've got to come up with potentially a large amount of cash in a short period of time frame. And that's what keeps people from being able to pay the liability in the first place, is that they don't have the cash to be able to do that. So unfortunately, the offer and compromise may not be an option. Being currently non-collectible or a partial pay installment agreement may be the case. For those of you that are not aware, the partial pay installment agreement is where they're making a payment and they'll just never pay the full balance. I'm working on one right now that we're trying to get the guy to a $250 payment on a $110,000 liability with 5 years left on the statute, which means he'll pay about $15,000 if he pays and gets to the end. But offer is something we're looking at. The problem he's got is the cash issue. Number two, obviously, again, there's an application fee, so there's additional money that they have to be able to come up with depending on whether or not they qualify for the low income exemption. Again, refund seizure. So here, this is where you need to be doing tax planning with your client from the standpoint of making sure that you minimize or if not eliminate their refunds so that it's not being lost, because during the application process as well as the year of filing, they get to keep their refund, which means that at this point they get to keep their 2016 refund and they will keep their refund for next year in this case. Now, when you're dealing with the offer and compromise, their full financial disclosure is required, and we will be going through later a little bit of what the difference is when if you have to do a full financial disclosure for a currently non-collectible or installment agreement, you fill out the form 433A or B, respectively, for individuals or businesses. When it comes to the offer and compromise, we'll be going through the forms a little bit later, and we'll show you the differences between the 433A and the 433A OIC, and we'll spend some time also on the B side so you can see the differences. Then number 5 there, non-refundable payments, which means that the payments that you make, whether it's the 20% down or if you're doing the periodic payment plan and you're making periodic payments, if you've made those payments and at the end of the day they deny it, reject the offer, then basically what happens is you lose those payments. You do not get those back. In regards to number 6, extends the CSED. Basically the clock stops. Once you've submitted your offer, then it's the offer time plus usually another 30 days if they reject it, because that you have 30 days after rejection to file an appeal. And so that is a drawback. So if it takes them a year and a half, it takes them 22 months to get through the collection or to process it, whether they accept it or deny it. That means the clock stopped that whole time. So if you had 5 years when you started, you still have 5 years when you end if it by chance gets rejected. And then, as we mentioned to you, there's some drawbacks, and one of the reasons is that the IRS basically is looking, you can't owe any further for the next 5 years. You can't have 1 penny of liability outstanding, otherwise, again, that will deny or terminate your offer and compromise. And then number 8, non-tax liabilities cannot be settled, which means that you have to deal with all tax returns, all issues. So if you're dealing with trust fund recovery penalty, individuals, businesses, whatever the case may apply and how it applies, you have to deal with those issues for those tax returns. But if you have child support, student loans, anything else that they can come after your refund for, you can't deal with those in the offer and compromise issue. And then if your liability is over $50,000, then it has to go through IRS legal counsel to get a legal opinion and make sure that they look at the hazards of litigation to see if it's something that's worthwhile for the IRS. So it's not even a guaranteed that if all the numbers work out that they would still say, hey, we'd rather challenge you in court in that regards. And they actually even have other tools in their holster here. So, Jason, do you have any other comments you wanted to add in regards to the downsides of the offer?
Nope.
Okay, and then I just want to address here, Randall asked the question here, can the IRS file a lien when the offer is filed? So he says yes, the lien generally will usually be filed during the offer process, so that is one thing that they can do. They're just not going to come after you and whack your bank account or garnish your wages. Now, here are the requirements for offer and compromise. Okay, again, as I've just mentioned, all tax returns must be filed. So you can't have anything that's open. You can't have any liabilities that haven't been established for any of those years. And if so, you have to deal with that first. And it's not uncommon for somebody to come in, they owe a lot of money on issues because they've had substitute for returns. And in this case, and Jason, just to confirm with you on this, but substitute for returns count as a tax return in this regard, or do you actually have to file an actual 1040?
An SFR counts as a tax return.
Okay. So in this particular case, if they've done a substitute for return, an SFR as we call it, then that will count as it's a liability and a return for the purposes of this. So you just need to look at your client's situation. I had a guy who came in to me, I guess a little over a year ago, and he ended up had the last return he had actually filed was the year 2000. Well, the IRS did a substitute for return for him for 2001 through, I think it might have been 13. That's the year he shut his business down, and he's now caught up with his actual tax returns in the last few years, and he really doesn't have any issues there. But you know, since they did substitute for returns for all of those years, we could enclose them all in as part of the offer. Now, you can't be in bankruptcy. If you're in bankruptcy, the IRS, again, remember, they're the world's largest creditor, and so when you're in bankruptcy, they can't do anything with you while you're in bankruptcy, which includes garnishing your wages, levying your bank account, so they can't even negotiate or do anything with you in regards to the standpoint of the bankruptcy. So that's going to be a downside. And again, the other aspect of it is that we've talked about that you have to when you're filing your offer, you have to be becoming the good little taxpayer and get to your client to the point where they're not going to owe any money. So whether if it's dealing with payroll, FTD is federal tax deposits, or they're making their 1040 estimated payments, whatever applies. If you're dealing with a C corporation, then they still need to make the federal tax deposit for their federal income tax. So you just need to make sure that they're doing that and doing that timely. And once you've submitted the case or you've gotten the case resolved, they should be paying you for a monitoring service afterward, just to maintain that you have the power of attorney active and you're checking it quarterly to make sure that they're either making estimated payments, tax deposits, so they're not snowballing this and causing all the work that you've done. Because if at the end of the day they don't make their payments, then they're going to be SOL, and it's going to terminate everything, and you're back to square one. And guess what? If they want to come back to you and do it again, you get a whole brand new fee, as long as it's not due to your fault. Just make sure you explain everything, have it in writing, do all that kind of fun stuff that we love to do just because people love to point fingers. Now, you must not be able to pay in full or via an installment agreement. So in general, if they qualify for any kind of installment agreement, this is where if you're going through the financial analysis, that you'll know right away whether they can pay it in full, and that might even be potentially liquidating certain assets. So if that can be done, then generally you're not going to be offering compromise candidate. And then the trust fund, for those people that are dealing with businesses and the individual shareholder or responsible person ends up getting assessed the trust fund recovery penalty, it must be paid or it must be assessed to the individual. Once that's been assessed to the individual, then you can take the trust fund recovery penalty along with the liabilities in regards to their individual tax returns, and then submit your offer with all of that included. Any comments you want to make on anything there, Jason?
Nope. This is your show.
Okay. So, moving on. Now, here are some things to be aware of. If your client has DOJ, that's Department of Justice, or AG, the Attorney General activity, generally if that means that there's potentially some criminal stuff going on, then you do not get to play ball with an offer in compromise. And not only that, but some tools that they have here The tax liabilities can't be reduced to a judgment. If the IRS deems that they have the wherewithal to get it, like for example, I've got a client right now that says that he owes $250,000. The only thing that he has is a house. That's the only asset. He's got about $140,000, $150,000 of equity in that house. He's got crap for credit, and he can't tap that asset. And so because of that, they can't get anything. And based on the way the math works, he fits for currently non-collectible status. But the revenue officer I'm dealing with has been mentioning to me that she is looking at reducing it to a judgment. What that means is they basically sue you in court just like any other credit card would, and when they do that and they get the judgment, that hangs out there, and so because the liens basically are still there, if they go and sell that house and get the equity out of that house, the government gets that money and it goes toward his liability. And so that's one of those things you have to make sure that that has not happened to your client as well. Now, restitution orders, if you have a theft issue or something of that nature on top of the fact that they have tax liabilities, then they can't be under restitution to pay that money back. Because if that's the case, then again, all bets are off and you can't deal with this. Or you can't file an offer in compromise. And again, the last one there, there's no pending litigation, criminal or civil, in regards to tax periods in question. So they just don't want anything involved, whether you're plaintiff or defendant, because if that ends up being the case, then if you were the plaintiff, there's potentially more money for you to have, and if you have more money, then you have the ability to potentially pay more on your offer, or vice versa, that if you had something there, it could hinder your ability to pay based on the information that you've provided. And again, the offer in compromise must include all tax liabilities unless you're dealing with the doubt as to liability. That's what DATL stands for, doubt as to liability. So what you're saying is there in the doubt to liability, ultimately we question if there's even a liability to begin with. But in normal cases, we're dealing with the doubt as to collectability, and in this case, you must include all the tax liabilities, as we said, trust fund recovery penalty, the 1040 penalty, any other civil penalties that might be involved, whether it's individual or business. So go ahead, next page, Jason. So this brings us to our next polling question. 2 times 3 equals, well, you gave them the answer this time, Jason.
Oh, dang it. Sorry. The correct answer is not supposed to be on one of the choices. I made an error there.
Usually that's what he does. Is it one of those, because we're concrete sequential math people and the answer has to be there. So the question is, I don't know if you can answer Kelly's question there, Jason, about how do you know about Department of Justice or Attorney General activity if client doesn't tell you? Would that be available in a FOIA request?
You can, if you do a FOIA request, you can get work papers from the revenue officer that might have indication of that. The easiest thing to look at those transcripts. I don't know the code off the top of my head. It's in the transcript code reference pamphlet, but Thomas, I like your answer. The correct answer is how much do you want it to be? Yeah, Kelly, there are codes on transcripts that indicate CID referral, Criminal Investigation Division referral for those cases. So this is one of the reasons why you need to have TDS, transcript delivery system, access through your e-services account. And when you have an active tax resolution case, you should pull transcripts on a monthly basis, okay? Because you'll see the changes in status, not to mention tracking payments and and all that stuff. But you want to make sure, that the correct things are being entered, or if something unusual, such as a CID referral, has been entered, you want to be aware of those. So, yeah, during active cases, pull transcripts monthly.
All right, where CID is the Criminal Investigation Division, and then Frankie asked where the codes are. That's all available in the Internal Revenue Manual.
No, there's a pub.
No?
And again, I don't know the number off the top of my head. I'd have to go look for it. But there is a publication that lists transcript transaction codes.
Right. Yeah, I have seen it. It is like what, a 300-page document?
Well, no, that's the big MFT IMF
BMF.
The IMF BMF Bible. I'm referring to. Let me do a Google search real quick.
Okay. We'll get that information to you. Maybe you can put the link in the
yeah, I'll find
in the chat section.
It's a pub.
And so we're going to end the polling question here. 96% of you voted. I love that we have some rebels in there that 4% of you said 0 and 4% of you said 10. So, okay. So here are the.
Thanks to Melissa. She posted the link. Thank you. Yes, that is what I was looking for. I will pop
okay. Is that available to everybody?
Yeah, let me pop it into the chat window. Thanks, Melissa.
Yes, thank you, Melissa.
That's exactly what I was looking for. It's the Transaction Codes Pocket Guide, is what they call it.
Yeah. Hope you got a big pocket.
Yeah.
So, okay, moving on. Types of offers and compromise. So we've got 3. Doubt as to liability, which is processed by the Examination Division. Doubt as to collectability, which is processed by the Collections Division. And then you have effective tax administration, where you get to play with both of them. So they are processed by the Collections Division, but Examination and IRS counsel basically get to be involved. And here's the basic gist of this. Doubt as to collectability is probably where you're going to spend 90% plus of your time when you're dealing with offer and compromise. You've got somebody who owes a liability, whatever the liability is, whether they owe $10,000 or $10 million, you're saying that they basically don't have the ability to pay. They have the ability to pay pennies on the dollar, and assuming that all the math and everything else works in regards to that we'll be talking about here in a little bit. As long as everything works out, then you're able to submit the offer and deal with the Collections Division. Now, when you're dealing with doubt as to liability, basically there you're saying, hey, we really don't think that he owes this money, and because your ability to deal with somebody on the examination side, that you're basically, it's kind of like another way of doing audit reconsideration. So when you submit the offer, doubt as to liability, the reason that it's done by exams is that they will look at why the information that you're submitting as to why you don't owe that liability. And then you can later come back as to the doubt as to collectability if that's still an issue in that regards. Now, effective tax administration, I've had many discussions with Jason in this regard, and this ends up being more of, ultimately at the end of the day, what it's saying is it's not in the best interest of the government to be pursuing the client taxpayer because of some particular situation. Whether it may be for them to pay it, it's going to cause a huge financial hardship. For example, I'm looking at it right now with a client of mine. She's dealing with a stage 4 cancer, and she's barely has any money to do, and she's going to be flying. She's here in Florida, in fact, right near my office here is where she's living, and she flies to Texas and LA for her doctor visits. She used to be in Texas, and she's got a specialist that she deals with in California that she has to go and deal with this because she's had cancer before, and I think that was part of what got her in the problem in the first place. She owes from, I think it was 2004 to 2006, she owes $55,000. but at the end of the day, she has $12,000 to her name. She earns less than $1,000 a month in Social Security, and so we're looking at having her, because we've also got a diagnosis letter from the doctor that basically says that she has a bad stage 4, I think it's like a colon cancer or something of that nature. And so we're going to be looking at doing that because she's dealing with enough in her life and trying to fight for her life that we're basically presenting it to the IRS that, hey, it's in our interest as well as yours that you don't pursue and we don't exacerbate her financial issues as well as her medical problems that we're dealing with. So that is where that ends up being the case. But again, if you've got hardship problems where they're having problems putting food on the table and meeting I'm a big fan of Dave Ramsey. I've teach his financial peace course, and he calls it the 4 walls. Basically, the food, shelter, clothing, and transportation, I believe, is the 4th wall. So if you're not being able to do that, the kids are going hungry, they're wearing radial shoes, and that causes other problems, then that might be, effective tax administration might be the avenue that you could look for in that case. So go ahead, Jason, go to the next slide. So now we're getting down into more of the little nitty-gritty on how we actually determine what makes your client an offer candidate. So at the end of the day, this is where you have to get. What is the offer payment options? Now we're dealing with the doubt as to collectability, and so when you get to this point, you're saying that can your client do either the lump sum cash offer, which is even kind of misnamed as it is, and the periodic payment offer. The lump sum cash offer is that they have to make a 20% down payment with the application and then make no more than 5 additional payments within 5 months of acceptance. So for example, if you were just to make the math easy, let's say your client owes $100,000 and they have to pay $20,000 down with the application. And then they could pay the remaining $80,000 if they could do it over 5 payments, or they can do it over, if you do the 4 payments, in the next 4 months, then they could pay the $20,000 a payment and be done with it once it's finally been accepted. But remember that the 20% down payment, once if they don't accept it, is gone. If you will, it's going down toward the liability. They get to apply it to the years that they want to apply it to, and then they just have to make sure that they make those payments within the time frame. And then the nice thing about this particular one is that once you've made your 20% down payment, then you don't have to worry about making any other payments while they're running through the process. So if it takes, again, another 1.5 years for them to go through it, then your client's not making the payments. So what that does is buys them time to come up with the money for the other 80% that they didn't pay. So there's the nice benefits of that. Now, when it comes to the other option is the periodic payment offer, is that your first payment is made with the offer application, but you're making monthly payments while they're evaluating the application. But again, remember that if it's rejected, payments in this case are not returned. So if it takes them 1.5 years and your client's been making 18 months of payments, whatever that payments that have been made, then they don't get it back. Now, in this case, any payments made prior to acceptance, you can actually designate to the standpoint of what year or taxes that you want them to be applied to. Now, the other big difference between these two is that when it comes to, we're going to talk here shortly about the reasonable collection potential, the RCP. The big difference is that in the lump sum cash offer, when you go to do, I'm going to assume right now that many of you have done an offer, not an offer, but an installment agreement, and if you've at least gone through the 433A with the client. And when you've determined that, here's the income on a monthly basis, here's the allowable expenses on a monthly basis, and let's just say at the end of the day, it comes down to $100 a month. That's what their ability to pay is. Well, under the lump sum cash offer, we have to multiply that payment by 12. Under the periodic payment offer, we multiply it by 24. So we take that plus the equity in assets, and that ultimately ends up being your offer. So, next slide, Jason. Okay, so let's talk about reasonable collection potential. Now, and again, many discussions I've had with Jason, when we look at reasonable collection potential, this is kind of what you should be looking at when you're analyzing anybody. I mean, unless it's an easy slam dunk, they're under $10,000, or maybe even if they're under $50,000 where financial reporting is not required, you should be looking at reasonable collection potential, because it really helps you to determine, is an offer even on the table, and if not, then you've got what other potential alternatives are you looking at. Now, when you're looking at reasonable collection potential, it cannot be zero, and it doesn't include amounts already paid. So if they've already been in an installment agreement, you don't factor those in. Unfortunately, then what you're doing is you're basing it on whatever the liability is today and what's your client's collection ability. So the IRS, the total amount the IRS could collect here from you within 2 years. And so, Melissa, yeah, the periodic payment plan is a 24-month, 2 years look at. Carlton, RCP is reasonable collection potential. That's up there at the title, top of the screen. Reasonable collection potential is RCP. So when you're looking at this, the IRS looks at your financial information. So if you were just preparing a regular 433A, you would know that what's the net equity in your client's assets. So if they have a $100,000 house and it's got a $50,000 debt, they have right there, right offhand, at the simple glance, it's $50,000 in equity. A lot of various equity is reduced, and we'll look at that in a little bit when we look at the actual forms. Then we look at the present and future income potential here. So because again, we're looking at what is the client's ability to pay. Again, we're looking at the analysis under the form 433, again, A or B, depending on your clients. We're looking at amounts collectible from third parties. This could be a note receivable, account receivable. So if there's other things that are due from other parties, then are those an asset that the government could go and collect. And then the other big thing that you have to be careful with people is, because when they're in this type of situation, they just love to say, oh, hey, they start knowing the process and they say, I need to get these assets out of my name. So what do? They do a quick claim deed on real estate and they transfer it over to their brother, to their son, to their parents. And you see all kinds of stuff that happens like that. Or they'll sign over the title on the cars so that those assets are no longer in their name. Well, guess what? Those are discoverable assets. They can be found. They're public records. They can subpoena those records. And so you got to tell people that that's not going to be the answer. That's not going to help them. Now, your minimum offer is basically going to be the sum total of the various numbers and amounts that in terms of words that we've put there. So net equity asset, the present and future income, the amounts collectible from third party, transferred assets, all of those can factor in to what your offer is. Been talking with a guy right now. I'm trying to get him to a partial pay installment agreement at $250 a month. And I'm trying to find a way to get him to basically get rid of that $250, and he might actually be an offer candidate where we might be able to pay $100 on $110,000 liability. So there are ways that you can, I'm going to use the word manipulate, but it's probably not the best word to use. but there are ways to refigure and recalculate the information, and I'll talk about some of those as we go through, especially when we start looking at the form. And now here, the last bullet point there, if your reasonable collection potential exceeds your tax liability, then you're just not an offer candidate. There can be certain exceptional circumstances, and there have been cases. I know, again, I've seen some things where people might qualify for an effective tax administration, even though they might have the ability to pay the tax liability. Again, it's usually medically related. There's something involved with somebody in the family that might get them out of being able to pay the full liability. So with that, any other questions? Stephen Weisberg says, yeah, massage the data, and that'll be one of those things that we want to we'll talk about a little bit on what some of the options are that we kind of how massage the data, as he likes to use. Okay, next slide, Jason. So we're going to talk about here why do we want to calculate this? Okay, well, at the end of the day, first, the IRS will. They're the ones that the IRS will calculate the reasonable collection potential. And then the second, we're trying to determine if you're even eligible for it. So if your reasonable collection potential exceeds the liability, well, then you're an installment agreement candidate. You're not an offer candidate. That means that you have the ability to pay, full pay, the liability. It's just going to be over time, over the statute, the collection statute period. If your reasonable collection potential is less than the liability, then you can be an offer candidate. And then if your reasonable collection potential is 0, you still could be a currently non-collectible candidate. But again, it's all going to depend on how the numbers work out in this regards. Now, at worst case scenario, what you want to make sure that you do is what we call the back of the envelope calculation. So you're meeting with your client the first time. Generally, when it comes to meeting a client for the first time, I might just do a rough amount. It just kind of depends on what information they come into you the first time, what ability they have or their memory as far as what they owe. What I find out is most people don't have any idea on really what they owe. They don't even know what years they owe. They don't know what years they've filed all their returns. So they just know that they have an issue and a problem, and they just don't have the ability to pay it. So I've gotten into doing what we call the split sales model, where we do a investigation of liability analysis, where we go and pull the transcripts and do some rough analysis on it. What's the collection statute, the CSED, what is their liabilities, and Tushun CSED is the collection statute expiration date. That's the 10-year collection period. So we look at that CSED and determine, do they have 8 years left on the statute? Do they have 2 years, 6 months? Are there things that have come across it that we've stopped the clock, such as maybe there was a prior offer submitted, they filed a bankruptcy, they went to appeals, they entered an installment agreement at a prior period of time. All of those have different periods that can stop the clock. And when you stop the clock, obviously that just makes it go that much longer. So what you're doing is you're trying to come up with a rough idea and see if your client even has the ability to pay with some rough numbers. And let's see, Melissa says, if the reasonable collection potential is less than 0 and a family member will give taxpayer money, say $100 to file an offer, can you submit a low offer like this? Well, again, if the math works, Melissa, at the end of the day, it doesn't matter where they get it. As Jason likes to say, if they can borrow, beg, or steal, and usually we don't really advocate the stealing aspect of it, but if they can borrow or beg the money from a family or a friend, work an extra job just to get the cash, or do something, mow a few lawns to scrape, especially if $100 is going to be a problem for them, then yes, technically you can make an offer for $1. you can make an offer for $10. So they do have a question on the form where it says source of funds. So you would put that there, but other than that, that really doesn't matter. They just need to know that because they're not expected to pay their liability by borrowing from family and friends. It's just that when they're submitting the offer, the IRS wants to know that they have the ability to pay it when assuming they accept the offer. Now, do we have another polling question coming up here, Jason? Yep. So this brings us to our next polling questions, and I apologize, I have no responsibility for this. Again, Jason gave you the answer on this one. He's asleep at the wheel on some of these polling questions. Any other comments or anything you want to add to anything I've said, Jason?
Nope.
Okay, and so just for those of you who are aware that we are recording this, and there will be a replay available in the near future for that. So if you have to leave, just remember that you only get the credit for the questions, the polling questions that you answer. You have to answer 3 for 1 credit, 6 for both credits. And this is what, our 3rd polling question? So this is our 3rd polling question at this standpoint. So hopefully you guys have all been able to answer that, but just keep answering the questions and make sure you push the submit button, because if you don't push submit, it doesn't count. It's as if you didn't even answer it. Again, any questions at this point in time, post them up there. We were at 88% voted, and we are moving right along. So we are right at the 1st hour of credit, so we seem to be right on time. Any other questions out there?
Dan, this is where I'm going to pass control over to you so that you have screen control. So you might want to have the 433A OIC up on your screen.
Okay, I've got it on my screen. It just needs to, you just need to get the right screen. So.
And then I will pass control over to you.
Okay. So just give me 1 second, everyone here. So here we go. And then let me get to the right screen. There. Can you guys see the? There you go. Okay. So we've got the offer and compromise on the screen. And then just let's see here. Let's see. Frankie asked a question. After the offer and compromise is accepted, does client have to file by April 15th each year, or can they go on extension? Frankie, the normal rules apply, so they can extend. They just can't have a liability.
Right.
So remember, extension only counts on the filing of the return, not the payment of the liability. So I would try to make sure that they have their, you do at least an estimate and have them pay as much as possible, just so that they don't get caught later when you have the return done, plus there's other penalties and interest on there. It's probably best to try and get it done by April 15th, but again, it just can't be, the return has to be filed, so I wouldn't make it late, 1, and 2, that they have to full pay the liability. Okay, so on the screen you can see here the offer and compromise version of the Form 433A, and I'll just try to make this a little bit bigger so you guys can see the form hopefully a little bit better. If you want to play along, go to irs.gov, go to the forms section, and what you've got to do is look for the form 656-B as in boy. This is where these forms are located. That is the offer and compromise booklet, as it's called. So just look at that, and this is where I'm following along. This is a fill-in form. I don't use this particular from the IRS site here. You can see I can type in my name if I wanted to, check boxes here. So just make sure that you're using this and saving it correctly. I use a tool called Canopy Tax, and I've been getting into really using it, and it's really becoming a great tool, and that's how I use to prepare these forms. And then when if you have not ever used these forms, please make sure that you read the instructions. Take the time to find out, read all of this information, especially at the end where there's the signatures and all that information available. So this is Form 433A. Again, it's part of the 656B packet for the Offer and Compromise booklet, as it's called. And obviously you start with some basic information. And as most of you know, if you've ever done anything in regards to tax resolution, you know that to really get a case resolved, you know a lot more information. If you also do tax prep for that person, you know a lot more about them on the tax resolution side than you ever did or needed to in preparing their individual tax return. So please keep that in mind, that a tax return is not tax resolution. There are some information that we need in regards to dealing with there from a tax resolution side, whether it's offer and compromise, currently non-collectible, or installment agreement, regardless of the case. But there's some basic information that you got to start with here, and this is mostly information you'll have. So you'll know where they live, you'll know their name of dependents, whether they're married, you know that they work, you might know who they work for, but you don't have a lot of necessarily this information, so you're going to fill in this. But here's where things start getting to know a little bit more. Generally for a tax return, like for example with cash, checking, savings, money market, you get into retirement accounts, investment accounts, you might know who they are with, but you generally don't know the balances. Unless you're also their financial advisor, you might know more of that information, but you generally don't know who they're with or how much they have in those particular accounts. So this is where it's important to start gathering this information. This is where you're going to fill this in, and notice that there are some exemptions that come up here. So they give you $1,000 exemption in regards to cash. Generally, if you're dealing with somebody like this, there's usually not a lot of cash. So and whatever's there, you want to try and make sure you get whatever it is before you even start going down that rabbit hole, because remember, people, at the end of the day, you're dealing with a professional tax debtor, because generally they come in, especially if they're an offer candidate, they have usually multiple years of liabilities out there. They're in poor financial condition today, and so you need to make sure you get paid first. Don't be paid last, because you'll be just like the IRS is and probably having to take pennies on the dollar if you get anything at all. And if you don't get paid up front, then just be prepared that it could be a pro bono work, and that's not how we want to deal with that. So again, you start here with the assets. You're dealing with retirement accounts here. What do they have? Now please notice that when you put the market value here, that it's got this little multiplier. What that means is that because of, say for example, because what they use here is that this is based on a quick sale value. That if you were to liquidate your whole investment account, you were to liquidate your full retirement account and use that to pay down the liability, that there are you're going to take a hit in regards to some of it, in regards to getting the cash out and be able to pay that. Now, cash surrender value, if there, and also if there's any loans, any other liabilities involved in here, all of those things come off first. So if you're dealing with, say, cash value of life insurance policies, you put the cash surrender value. If there's any liabilities, then we determine what ultimately, again, at the end of the day, what you're looking for is the net equity in these assets, less the quick sale value. Section 3, as you can see, now we're starting to get into real estate. So again, as far as real estate is concerned, you're looking at house, condo, co-op, timeshares. This includes whether it's their primary residence or if it might be a rental property. Next, you're going to look at vehicles. And vehicles are going to be, unless they're driving really expensive brand new cars, and even then there's probably a lot of debt in regards to those assets, so there's probably not going to be much value. But Here's where it could be that if they have a boat that's paid for, motorcycle that's paid for, collectible cars that there's no debt on, then these are things that are going to ultimately hurt them in regards to the fact that the equity in those assets are going to be involved. As we continue along here, we even look at the, again, here's where we look at other collectibles. It says, notice how it says do not include clothing, furniture, and other personal effects, but here we're dealing with other valuable items. Jason was telling me one day he had a case where the guy was a gun collector, and he liked to collect old historical guns. He had a particular gun from, Jason, correct me if I'm wrong, this guy was a World War II gun in a working condition. It was like worth $50,000. And in an unworking condition, which it was like still was $20,000. Was that
right.
the case?
Yeah.
So this is where you would want to make sure that you disclose this information. Anything that is discoverable in any type of public record, you definitely want to make sure that because the IRS has at their disposal, they got the clerk of the court, they got Department of Motor Vehicles, they got the court system, and I'm sure there's a lot of other different ways that they can find out whether maybe if you have insurance on jewelry. If you have a safe deposit box, they can find out if you have that at the bank, and they want to know what's in the safe deposit box. Now, if they have a safe deposit box, I would probably just disclose on it that, because I heard of a case where the woman had, it was valuable to her, but all it was paperwork, like her trust and will and all of that, life insurance policies, and all of that information was in her safe deposit box. Just let them know that, hey, we've got a safe deposit box, but that's all that's in it, that you're not trying to hide the Hope Diamond in there and, for safekeeping. So make sure that you disclose that, and as well as notice that the last part here is an interest in a company or business that's not publicly traded. So if you got the guy who owns an S corporation, a partnership, you're going to put all of that, and this is whether it's, and now notice how it doesn't say whether they're active in it or not. So if they happen to be a passive investor in something, then you need to make sure you disclose it, and ultimately we're putting what it is and the value of it, whatever we determine the current market value. Now obviously this is not a class in determining valuation or valuation of things. That's a whole separate discussion there's even a whole certification in that. At least I know there is for CPAs, and I'm sure EAs, if you wanted to get certified in that, you can do that as well. But you keep that in mind. Now, notice on this that this form also deals with people who are self-employed. So if you have a self-employed individual, you deal with the 433A. If they are not self-employed and they do have separate businesses, or or you're dealing with an individual and the business has a problem, because that can very well be the case where a business might have the business may have the 941 payroll liabilities or 940 or anything of that nature, and then the trust fund recovery penalty might be assessed to the individual. So in that particular case, even if the individual didn't have any other liabilities, you could be doing an individual and a business offer potentially in that case. So you would be filling out both the 433A OIC and the 433B OIC. We're going to go through the A here, and we're almost we're a little over halfway through this, but when you get through this, we'll fly through the 433B. So again, here you're listing all of the assets for the self-employed individual. What assets do they have in their business? Again, notes receivable and accounts receivable, and then here's where we look at the business side of the income. So here you can just, in summary, you might want to even potentially look at including a profit and loss, if necessary, include a balance sheet, fixed asset listing, and if you don't have any of those, then that's where you need to try and recreate those types of things. Now, Jashun is asking questions in regards to the market value. Generally for a car, yes, I would probably use Kelley Blue Book in regards to that. But when it comes to real property, I wouldn't go with Zillow. Really, you need to. I mean, you're going to use Zillow for quick determination of this, but at the end of the day, you really need to get a better look at what's the true value, because the IRS is going to do their appraisals. You don't necessarily have to do a full appraisal. You can do a BPO, a bargain purchase. What is it? A
broker price opinion.
Yeah, broker price opinion. I don't know why I can't ever remember that. Broker price opinion. Generally, depending on the area you're in, can probably get away with $50 to probably a couple of $100 in maybe bigger markets versus an appraisal. Like in here in Florida, I think they run at least $300 for a residential property. In higher markets, you could probably pay a few $1,000s for a full appraisal. So, so you want to make sure that you've got some information to support your valuation, because I just in dealing with, I was telling you about the gentleman who owes $110,000, and right now we're looking at getting him into a partial pay for $250,000. When we submitted that information to the revenue officer, I submitted some pictures of the vehicle because the paint is starting to peel, and he's incurred some major medical, or not major, yeah, major medical for the car anyway. It's in need of some repairs. And we looked at the Kelley Blue Book value for the year of the vehicle, and we submitted that information, and it really wasn't worth a whole lot. So just use whatever you can and submit that information, just so that you have some basis of where it's just not a number you pulled out of the air. If you need to on a collectible item, I'm sure there's some way that you can get somebody to write a letter of a rough estimate of value. And again, you're putting the value, and ultimately you're determining the quick sale value on this. Now, here's where the 433A OIC kind of differs from the 433A. If you've ever been through the 433A for an individual, this one goes into kind of a little bit more detail, or expands it out in regards to this, where in regards to the form 433A, this is put in more of a condensed table for submitting all of this information. Now, while we're at it, I'm going to, for those of you that might be new to us or to this type of work, please note that there also is the 433F, as in Frank. That form is a very shortened version, and that is when you're dealing with the Automated Collection Service, ACS, and when you're dealing with those people, they only know the 433F. When you're dealing with the 433A, 433B, you're generally dealing with a revenue officer in a local office that knows, and they only know this form. They don't really know the 433F. So now, when you're dealing with these forms, if you're dealing with the revenue officer, then submit the offer to the revenue officer, and they're supposed to send it up the ladder so that it becomes to get it processed. So here is the information. Now, please note, remember how I talked about tax return versus tax resolution. There are things like child support received. So if you have that single mom who's having problems, maybe she's getting some child support, but not all the time, which is not uncommon. Whatever she's received, she has to include here. If there's VA benefits, that's not taxable, but it is includable as cash here, which is one of my problems with the guy who owes the $110,000, because he does get some VA disability benefits. There's a whole separate course that we go through in the detail, but here is the various items from the allowable expense side, and I suggest that you look into this, the collection financial standards. Again, this is looking from the small business and self-employed aspect of it. I just type in collection financial standards for the IRS, and it'll pop up the tables that allow you to fill in this information. Now, notice how it's got all of these boxes that will total these various numbers. At the end of the day, we are looking for box F and box A. So box A, and if you have self-employed individuals, you're looking at adding that additional information here for box B from the business side and box C from the income side. And then at the end of the day, box F is the remaining income. So if that, again, the answer is 100. So if I type in 100 here, then what calculates over here is this would be $1,200 if I'm going to be doing the lump sum payment offer. Okay, and that's the, and if I'm doing, so here it says if you will pay your offer in 5 or fewer payments, that is in reference to the lump sum payment offer. And if you're going to pay it within 6 to 24 months, that's the periodic payment. Then if I put the $100 here, and I'm not going to do this one, then what that means is that we've got here $2,400. Now, see, this is where we talked about the present and future, because what we're talking about is we're talking for the next 24 months. This is what their ability is to pay. Now, if we look at the net assets, and let's just say the net assets was $10,000, and we do the offer here at, and we're using this, then this is what our offer amount would be. Now, lastly is this very important question section. Now, here they're looking for, are you a beneficiary of a trust, estate, or life insurance policy? At the end of the day, they're just looking to see if you have, if there's any other monies that might be due to you, and then potentially what time frame they might be looking for. Well, are you in bankruptcy? Well, if you're in bankruptcy, remember how we said that they can't do anything. So if you answer yes, that's end of story right there until your bankruptcy is discharged. Have you filed bankruptcy in the last 10 years? Well, they want to know that because do you have the ability to file bankruptcy again? Are you a party? Are you or have you been a party to a lawsuit? Remember that if you are, then that's another thing that that they can't deal with you in an offer and compromise. For the last 10 years, remember how we talked about transferring of assets? For the last 10 years, have you transferred any assets for less than their full value? Which means that they did a $1 transfer of title or a $10 quick claim deed. Those items can be clawed back, which means that the value of whatever those items are going to be brought back into that. And even though they think that that it's not, because it's not in their name, unfortunate to the buyer of those assets or the now current owner, they get to not keep that as their assets anymore. In the past 3 years, have you transferred any real property? Have you lived outside the U.S. for 6 months or longer in the past 10 years? And the big thing about that is that's another thing that extends the statute of limitations for that matter. So if they go out of the country and they're gone for more than 6 months, guess what? Clock stops. It's as if you left the country and you had 8 years left, and when you get back, it's still 8 years. And then do you have funds being held in a trust by a third party? So that could be potentially other escrow things that you may need to look at. And then finally here, this is another thing where I'm just telling you to make sure that you look at all of the various aspects of the form. Read everything. Make sure you include everything, because if you don't, it's going to come back to you. Now here's the 433 OIC, 433B OIC. This is for the businesses. Again, for the most part, it's very similar here, other than now instead of you and a spouse, it's you and your partners, owners, shareholders. We're looking at the cash investment. Now notice I didn't switch forms. This is still in the 656B packet. And so you got here business vehicles, office equipment. We're looking here at the income and expenses of the business to ultimately determine the same exact analysis. What's the income? What is the net equity in assets? And what is the offer that here at the end of the day that the company is going to make? And remember, and this says it says more than one time here, your offer must be more than 0. Do not submit an offer with 0. at least put $1, put $100, put $10, whatever it is. Notice though it says here, that is a good way to get your offer rejected if you don't have an offer of at least $1. And I've heard of, Jason and I usually just do it $100, and if they truly would owe 0, then do that. Notice how these questions are, for the most part, very similar. And then here, again, you're going to have the questions that you're going to make sure that you've checked to include all the proper documentation. And then lastly, here's the actual offer and compromise form. So these are all the financial forms, the 433A and B, and then here's the actual offer. So make sure that you go through and review this so that this can, you're going to put all the years involved of all the taxes that you're asking for. This is determine your low income certification. Remember how we talked about that the application fee here at the bottom of the screen is $186, and if your taxpayer fits in the income thresholds here, they can have that application fee waived. If you're dealing on the business side, here are the business liabilities that you have outstanding. You're going to collect. Now notice it says doubt as to collectability and exceptional circumstances, which is the effective tax administration. So when you're dealing with that, this form is for those two. There is a complete separate form, and you look at the 656L as in Larry for the doubt as to liability. And if you have that type of situation, it's a whole separate form, and that's just primarily because you're dealing with the examination division versus here you're dealing with the collection division. So if you fit into one of those two categories, you're going to put that in there, and then here's where you're going to fill out your information. Now, one neat trick that I had another gentleman mention to me, that what he says he always does is he submits a periodic payment. And again, you got to look at it and evaluate it for your particular situation and your client. But he says that he submits the periodic payment. He says he puts what the offer amount is, but when it comes to the payment, he offers, like let's say it was $10,000. He would say, we're going to pay $100 now. We're going to pay $100 a month for the next 23 months on top of that, and then the last final payment will be, so if it was $10,000, we're going to pay in $2,300, and so at the end of the day, what is that? $7,700 is what our final payment is. Well, if the IRS comes back and rejects it, then that helps minimize the cash outflow, and as long as at the end of the day, at the final 24-month payment, your client can come up with the $7,700, assuming it gets accepted, that is one way to do it. Remember how that if we did the lump sum cash offer, that they must include 20%. And then you determine how you're going to pay, if you're going to pay for the next 5 months or 5 payments after the offer is accepted. And then finally, the big piece ends up being here is the offer terms. Please make sure you read and understand all of this. You explain these, and I would highly suggest that you have your client read all of these so that they know and understand that. They can come to you with any questions so that you can get this all resolved. Jason, did you want to go through another polling question while we're at this?
Yeah, I was actually just about to flag you on that.
Okay. So while you're doing that, I will answer a couple of these questions. A couple of people asked about Canopy Tax, the software, and yes, Canopy Tax, Pitbull, there's a few others that are out there, the Audit Detective out there. You can use any one of them. I've only used Canopy Tax. I can't speak to Pitbull or the Audit Detective, but the nice thing I like in regards to the Canopy Tax is that I input the information. In fact, let me rephrase that. When my client inputs the information, because they give them a link to a survey, they provide all of the information, give me all the documentation. They can even upload it to a portal there. And do you have the question up, Jason?
Yeah, it's up.
So go ahead and do that. Please answer the polling question. We're going to take it down here in a second, but Canopy tax is nice because if you can look at the 433A, you can look at the 433 OIC, and all you have to do is flip the forms, and it fills in the blanks for all of the information. You just need to make sure that all of the appropriate information has been provided. Melissa asked, what would be the criteria for filing an offer on payroll tax, the thought that gets transferred to individual if not paid? Remember, Melissa, that what gets transferred to the individual is the trust fund recovery penalty. The payroll tax still stays with the business, and if it's in business, that's when you would want to determine going for an offer and see about that. Danielle asks, when entering the tax years, I've had a couple of examiners come back to me, list them out individually instead of listing arranged. So, I guess, if you've got examiners coming back to you to do something like that, that's fine. If they want to be a little nitpicky from that standpoint, I guess from the legality side of it, then yes, you'd want to just list them out separately, just so that there's no confusion as to maybe there's a gap in there in the year that doesn't need to be involved. So you just put the years where they're that you're including in regards to this. So 10 seconds left on the polling question. 81% of you have voted. So please make sure you get that in. We've got 2 more questions to go in the next 20 minutes. So again, just as I finalize this, make sure that you look at the 656B, look at the booklet. The 433A, the 433B are all included. And if you use a software like the Canopy Tax, just make sure you review it in detail. Make sure you have all the supporting documentation in regards to that. So with that, I think we are ready to turn it back to you, Jason. So give me 1 second here, and I am turning it back over to you. Okay. Yes, I see the screen. Everybody see that? I can see it, so let me know if you can't. So as we come down to the home stretch here, here are some things that we give you reasonable collection potential pro tips, the RCP, that you make sure that you understand the collection financial standards. It's important to properly represent the clients. So making sure that you fill out the 433A, that's your collection financial standard financial form, the 433A, the 433B, and make sure that you have the supporting documentation. And then always calculate, always calculate the RCP for every tax resolution engagement. The only ones that you shouldn't do are like I said, the slam dunks, when they owe $10,000. And I mean, even then, it still depends on their ability to pay. But ultimately, if you can do the quick math and they owe, $8,000 and they can pay it in the next 2 to 3 years, then you might want to look at one of the other options for installment agreement. But look at the reasonable collection potential, because especially if you have to end up going the route of submitting a financial statement because of the type of other plans that you look for. Maximize expenses, minimize income. When you're, I'm going to give you a couple of tips here. So for example, the gentleman that I got $110,000 liability, trying to get into it right now, I'm trying to get him into a partial pay installment agreement for $250 a month. One of the alternatives that we could use is that he could go and say, buy a car. He has no car payment. He has a car, but there's no car payment. So we can't take anything in regards to his car. Well, he needs to have a car. His car is on its last legs, and so it's not unreasonable for him to go get a car for a $250 payment. Guess what happens to his payment to the IRS? Well, if we can do that, that $250 goes away and it turns into a car payment because we're allowed to take $250 for that. Another thing that we're looking at is he's making payments to me. He owes me, so he's paying me a little bit of amount. Right now, I'm just happy to get anything, let alone, because this is one I've got too much invested in. But if he could increase his payments, instead of paying $250 to the IRS, he could pay an extra. We were talking because he owes a liability to another individual, a friend of his, and he actually has a written note agreement that we did get included. He's paying $150 a month. I said if you could write the agreement where you owe him $300 a month, you pay me an extra $100 a month, and now there's another way to get rid of that $250. And yes, you can include our liabilities because obviously the amounts that they're paying us as an amount for your analysis in the collection financial standards. So just keep that in mind. And then lastly fight for asset equity table valuations. So, if you've got a valuation and you've got a big disparity, then, you've got to go to the mat sometimes with the IRS and say that your value is unreasonable. Because especially when you're dealing with collectibles or real estate, you should be able to come within a reasonable amount, but we're back in that market where things, at least here in Florida, I know things have been really going crazy as far as the values of real estate increasing. I'm on a city board here, and they looked at, we were looking at acquiring some property here in the city of Rockledge. And back in July, the people that were leasing the space were looking at acquiring it. They got a valuation in July that said $350,000. We just got one from the city, and that came at like $430,000. That's what the value came, and now we're talking like 7 months later. So that's just to show you how that can change. So this is one of those things where sometimes time is of the essence when you're filing your applications, because once you've submitted it, you've submitted it. They can't come back and ask you, if you win the lottery or the value increases, $100,000 or more, they can't come back to you on that unless they reject it, and then you have to start all over again. So make sure you fight for that. Next slide, Jason. Okay, so we're next polling question. We're going to do this one quick. So please make sure that you put that up. We've got a couple of other questions here. Let's see. Frankie asks, client cashed out life insurance to pay 2016 balance due. IRS wants to include it in the offer and calculation. But IRM says count if used to fund the offer. This isn't funding the offer, it's paying the 2016 balance due. Any thoughts? I don't know if you have any comments in regards to that one, Jason. I mean, obviously, if you can show that the amount that he took out was close to the tax due, and that's part of the requirements, is that he's trying to stay current with his information. And if you need to, that's where maybe you go and take it to appeals. Have them reject it and go to appeals and go that route. Because otherwise, if you've got a unreasonable examiner in regards to this offer, then you might want to do that. Do you have any comments on that, Jason?
Yeah, here's the thing about that. You'll notice that on the 433A, it explicitly has a block for cash value of life insurance policies. And so, if he had the asset, then it goes into his asset calculation. So yeah, it goes into the OIC calculation, even though he cashed it out in order to pay down the taxes. So, I mean, it's right there on the 433A, and so what you're going to want to do in that situation, like Dan already said, is take it to appeals and say, yeah, the asset existed, so we understand why you want to include it in the calculation, because that is proper, but also note, we already gave you this money. Like, the IRS already has it. We already gave it to you. So this could either be a situation where you take it to appeals and get them to deal with it, or potentially could be one of the rare cases where I would recommend getting taxpayer advocate involved under under grounds of equitable treatment.
Right. Yeah, I mean, I think at the end of the day, I think what you're saying, Jason, is that at the time he submitted the offer, he had it, and if it was, basically, if you will, they use the term dissipated asset. It's, basically it's not there anymore when they are going through and processing the offer, then that's where your issue is. But again, like I said, the appeals may be your position. So, okay. Moving on, processability. Remember, you must be current and compliant. We say this in every class that we talk, whether it's installment agreements, currently non-collectible, the client must be current and compliant, which means all returns have to be filed. Generally, we have a 6-year look back, so if they haven't done substitute for returns, SFRs, for any of those periods, make sure you prepare the returns, that those are filed, they're on record as being filed. Any existing levies are, if they're out there, they stand. You can still fight to get those back from a different perspective, but that they're out there. Once you submit the offer, though, then they're generally prohibited from coming after unless they have a jeopardy levy, which again is a whole separate 2-hour discussion. If you have a business offer, the trust fund must be paid. If you have an individual offer, then it must include the trust fund recovery penalty. So that means if you have to roll over and just say to the revenue officer, just go ahead and assess it, I need it to do that to submit your offer and compromise, then you do that and have them assess it. And then you deal with the pennies on the dollar. Next slide. And then to make sure, again, it's processability, and make sure that it goes through the system, that the offer and compromise filed solely to delay collection will be instantly rejected. So if you're submitting it just to buy time to do something else, or to possibly, again, obviously if you're submitting it, the collection statute still stops. So if you're just trying to delay the whole process or keep them from levying or garnishing wages, bank accounts, or anything of that nature, then yeah, it's just going to be rejected. Make sure that it's not missing the application fee or any down payments that you need to make, that that they're not in bankruptcy, and that make sure that you have a complete form, Form 433, all the supporting documents, and if it's not processable, they have a process examiner that looks at it before it gets to an actual examiner who will look at it in detail. A process examiner just looks at it, does all the proper documentation here. Generally, we're looking at 3 months bank statements and everything else, pay stubs, so that they can look at it. But if it's not, they will send you a letter, and it just makes the whole process take longer. So just try to submit an application up front correctly. And again, once you submit the offer, it's based on the offer and information at that point in time. So if you submit it and everything processes along, and then 6 months later they win the lottery, as long as it gets accepted, then you don't have any issues or problems with that. Next slide. And then this takes us to our 5th polling question, or 6th? This is the final? Yes.
This is number 6.
This is the final.
And my favorite
you added a few new things on this one. So what happens when a frog's car breaks down? It gets towed away. Batman comes to the rescue. Silly goat, frogs can't drive. The drugs wear off, and you'll see it's all just an illusion. Yeah, I like that one. That one's better. I like the way you worded that one. So if you're a Batman person, we saw the Lego Batman movie a few weeks ago, and that was pretty good.
Oh, yeah?
Yeah, so that we're probably going to see Beauty and the Beast this coming week. Although I want to see the new Kong movie, but that's probably going to give me nightmares. I don't know, I've had King Kong nightmares since I was a kid. But yeah, if you guys would please answer the polling questions. Now is the time to get any of your last questions out. And so go ahead and do that. We've got
5 slides to go through, by the way. So
yeah,
so don't log off yet. Even though we're at the last.
Don't leave.
Even though we're at the last polling question, don't leave. All right, I'm going to go ahead and close
Yeah,
this.
so we got 10 minutes, and I'm going to do the best to fly through this, but at the same time give you the information. So, offer investigation process. So here again, the IRS verifies everything you report. They look for more, just because, you know, what is it? We had a conference where a guy said, trust but verify from
Correct.
your perspective.
Yep.
So try to go after it, make sure, because that's what the IRS is going to do. We'll show you, in the next slide, we'll show you some of the various tools at the disposal of the IRS. Again, make sure if the Form 433 shows ability to full pay, don't even file the offer. It's just going to be a waste of time. You're going to make your client mad at you. Make sure you have professional liability insurance, but at the same time, you don't want to give them the reason to file a claim in regards to that. And they generally will look at the current 3-month period, and the current 3-month period meaning historical current 3 months. So here we are in March, and you're going to go back through December, January, and February as far as pay stubs, bank statements, investment statements, retirement statements, anything of that nature. You're going to get current values as current as you can get them. And then if you're missing any of this information, you will receive a letter that says, we need that information. Now, it's not uncommon since these things take a long time to process, that they date information. Asset verification. Okay, this is where the IRS has their ability to look. They have Department of Motor Vehicles, UCC filings. That's the filing of any debts. So if there's a mortgage filed, if there's factoring of receivables are filed. The UCCs are filed against assets. There's liens in place, anything of that nature. They're going to look for county records, clerk of the court, or whatever you guys call it in your particular state. PACER, I forget what that really is, but public access court electronic records. Did I get that right, Jason?
Ding, 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 ding.
Yes, I got it. Public access court electronic records. So they look at to see if there's any court cases that you've been in, you currently in. They do pull credit reports to see what kind of loans are out there, credit applications you've made, because again, usually what they would ask for is denial letters from for home equity loans or something of that nature. They'll look at valuation verification tools such as Kelley Blue Book and other realtor reports. And then for an operating business, expect that they're going to come and make sure that the assets you're claiming are really there and that you're not missing a few things or two. Next slide. Again, if anything is missing, the IRS will contact you. Make sure that you respond appropriately by the deadline. Unfortunately, tax season is not the best time for these things to happen, but unfortunately, that's what's happened. I'm dealing with an exam right now on a client. I've been trying to beat this guy over the head for the last 9 months. I was dealing with this starting last tax season, and he still hasn't gotten to me. Wage and income verification, they will do third-party contact. They will look at their internal transcripts. They will do financial summons to the bank, to employers, and gather the information. And then negotiations will always center around asset valuation and expenses. Generally, they don't usually question income too much, but they can look at that. But the asset valuation is going to be probably the biggest thing that they have to do. Next slide. Now, once the offer has been accepted, this is the part of the must. They absolutely have to do these things. They must file the tax returns on time. And going back to the question that was asked earlier, so it has to be a timely filed return. It can be extended, but it just has to be paid in full. And it has to be done for the next 5 years. So if they even owe $5, that can terminate the liability or terminate the offer in compromise, and all of that basically forgiven debt comes back and will come back to haunt them. The IRS will keep the following year refund. So here we're filing now, and they will keep the refund for next year, the 2017 refund. Penalties and interest still accrue, but once the offer terms are met, then all of that just falls off like the rest of the debt. Failure to meet the offer terms will reinstate the full liability. And yes, the tax lien will stay in place until it's paid. So if it takes you, if you go the extra 5 months to pay it, or you're paying it over the 24 months, then the lien will be released once that time frame, and generally I believe it's usually a 30-day time frame for that to release. Next slide. And again, some helpful tips, hints, tips, anything that you want to know about this. So have you maximized your expenses? Again, fight for the expenses. Just as I said, if you're dealing with a self-employed individual, if they don't make estimated payments, make estimated payments. Start making that today. Make it monthly. Have them set up an EFTPS account and do it now. If they pay $500, that's $500 that's going to come off of their amounts that they have to pay the IRS. Minimize the income. Again, offer, just like with currently non-collectible, when they're flat broken unemployed, that's the best time. When they're the lowest, they've been beat up and kicked on the ground, that's when you want to try and file these offers. Make sure that they're not hiding assets, and don't be an accomplice to that, because then you can can be fraud, it can potentially be criminal, and if you have any indication or inclination that they're doing that, then don't be involved any further. Just disengage and take the consequences of that than being involved with something where you know further information. Accept the trust fund recovery penalty as a personal assessment if you're trying to do one for an individual that has a business with payroll issues. Again, you have to take care of all the open tax accounts at the same time. So if they have, say, 20 years worth of liabilities and they're still open years, you have to include all of them. So make sure you do that and include all. Notice how it's in caps. I can't stress it enough. Include your financial data with the initial offer, because you don't want to have to keep coming back, because that doesn't look good for you when it keeps coming back and your client's wondering what's going on, especially when you're going to have all these periods of you're not going to hear anything or know anything until they actually send something back, and you don't want to have it be delayed, because your client is losing sleep, they're stressing out over this, they're fearful that the IRS is going to come after them, so you want to make this as easy and painless as possible. And then the final slide, right now we are 2 minutes over, so I'm actually doing pretty good here. So in conclusion, make sure that your client actually qualifies. So make sure you double check the offer, the OIC eligibility criteria, because again, don't submit an offer if they're not eligible. That's what a lot of people will do. These offer mills, companies, they will just submit an offer because they say that they can and they're going to get this money, and then they don't care. They get paid $5,000, $10,000, and then it gets rejected, and they go, oh well, and they just wasted that money when they could have probably paid you, the same or less, and you could have told them right off the bat that, hey, you don't qualify for that, but hey, you do have other options. Make sure your client understands the downsides. Like I said, go through the agreement on the 656B booklet at the end of what the terms of the, what do they call that here again, the offer terms. Section 7, make sure that you review that, you understand it, and make sure you explain it to them. And then thoroughly explain the payment responsibilities, and again, I would even go as far as have a little written agreement yourself that basically says, that spells all of these things out, and that they are attesting to that this is the case, because they can't come back and point a finger if you've got a document that says, hey, I'm explaining all of this to you, just like you need to have an engagement letter. Do that whole process and make sure that you've gone through all of that. Now, having said all of that, any final parting questions that you'd like to add, Jason?
You want to cover Melissa and Danielle's questions that I answered there about unemployment?
Sure. Let's. Yeah, we got a few questions here. Danielle asks, if an offer is filed after tax day, i.e. June 2017, would the following year refund then be the 2018 refund in 2019? So are you saying that if you're asking about filing this year's tax return, then the refund, not for the 18 filing season. Well, it's the 18 filing season, but it's the 2017 tax return. So basically, it's the year in which that the filing is involved. So it's the refund for the 2017 tax year. So that means that that's going to be next year's tax refund if they're going to did I say that right, Jason? Does it make sense?
Yeah, so the way it works is that the IRS will keep the refund for the tax year associated with the calendar year in which the IRS accepts your offer. So I actually missed a few words in my answer to Danielle. If you file in June 2017 and you are fortunate enough to get the offer in compromise accepted before December 31st, 2017. So the entire process is wrapped up and they accept the offer in this calendar year. Then the IRS will keep the refund on the 2017 1040 that you file in 2018. However, since it usually takes about a year or more to get an offer through the process, if you file your offer in compromise in June of 2017 and they don't accept it until June of 2018, then they are going to keep the 2018 refund that you file on in 2019. Does that make sense?
Yes.
Okay.
Yes. So hopefully everybody understands that and it makes sense. So then let's see here. And then Melissa's question, I thought you should not file an offer while unemployed as it is a temporary situation.
That's the best time to file.
Ultimately, yeah, at the end of the day, it is what it is. And if, you know, for most people, if they're unemployed, yeah, they're not unemployed for a short period of time, although, I mean, because now if you look at it, we're in a tight labor market. So there are not as many jobs out there, and so there are some people that have certain skills that they may not be employable in other types of work. So so it's not uncommon for somebody to be unemployed for 6 months or longer. So just keep that in mind. I wouldn't use that as a reason not to file the offer. In fact, that would be probably the reason I would make sure that they use an offer, because obviously the income is at its lowest when they're unemployed, even if they're including unemployment income, because the unemployment income is a fraction of what they would have earned had they been working a full-time job. So with that, I think that sounds good, and make sure you guys come back. The next 2 weeks, Jason will be teaching the liens and levies, as well as, I don't remember, is that next week, liens and levies, and then appeals is the following week, 2 weeks from today?
That sounds right, yeah.
Yeah, so liens and levies is next week. Appeals will be 2 weeks from today. And then if you'd like to continue your education and learn about further, come see us down in Orlando in May, the 9th through the 11th. Many people are already, I think, what's the last count, Jason? We've got, what, 25 or so people
Yeah, we got about
registered?
25 registered, yeah.
Yeah, and please know that space is limited. So if you'd like to continue your education on this, come see us in Orlando in May. We're combining some technical along with some marketing there. Jason's putting up the information here. The 2017 Tax Resolution Leadership. If you look at, what is the site that you have to get there directly, Jason? Tax?
Oh, is it, let me check. I own too many domain names.
It's Tax Resolution Webcast.
No. Is it Tax Resolution Seminar?
Yeah, well, if you put in Tax Resolution Webcast, it pulls up a site that gives the tax resolution leadership as one option,
You know,
as well as the class that you guys are
I'll just put the direct
in.
link to Eventbrite in the chat window here. So,
yeah, so if you guys want to go there and register for that, we highly encourage you to just continue your education in this, and we help with the marketing and how you find these people, how you process them, how you deal with it from a practice standpoint, and you don't put yourself in hopefully a situation where you're going to get sued for certain things there. So, but keep in mind that the price, is it going up further from this, Jason, or is this the full price?
So right now the price is $600, and yes, on April 1st it will go up to $700. On the 1st of every month it goes up by another $100. So register now.
Yeah, and those people that are members, you get a 30% discount, but even then, it's still increasing $70 every month for you guys.
And I also want to
just make sure you do that. Go ahead.
I also want to point out that at this event, this is where we're going to get into the weeds on 941 representation as well, which is the bulk of what I built my career around. And the fees are higher. It is not uncommon for them to have 1040 cases attached to them, to the individual that owns the business. But we're going to get into some of the specifics on the 941 stuff, and that's where the bulk of the tax debt owed to the federal government is 941, not 1040. Okay, so that's where the bigger opportunity is, and it's where the higher fees are. It is the best place to be, and we never ever cover any of the 941 stuff in the online format. Okay, we only do these live event. So
it's a category that we have not really gone much in depth, if any. We've kind of mostly talked about individual side or things that will connect into like liens and levies and appeals that will, it doesn't really matter. It works the same on both sides for the most part. But I would highly encourage you guys to register and come to attend that, because there's a lot of good information. And what is the maximum capacity we have, Jason? Is it 40?
Correct.
Yeah, so that means we only have 15 seats left, and if you have not registered, please do so as soon as possible, as well as book your hotel room. There was some comments on our Facebook page that that it was the hotel is filling up fast. Not that there are not other hotels around, it's just you're not going to be in the same hotel with the rest of us.
Yeah, and actually I need to call, as soon as we get off the webinar, I'm calling the hotel rep to see if we can get some more rooms freed up. So.
Yeah, I booked mine this morning. I forgot myself.
As did I.
So with that, I don't see any other question. Thank you very much for being here, everyone, and I hope you enjoyed this session, and we'll see you next week.
Thanks a lot, Dan. Have a good one.
Okay, talk to you later.